Hey everyone, welcome back to Gold Off the Charts. Forget the noise. Get the daily financial edge you need to see exactly how wealth is built. Over the last couple of days, I know many of you have felt like you're on a total emotional roller coaster. We've seen a noticeable dip in gold and silver after they hit record highs, especially silver, which is known for being extra volatile. If you're a regular here at Gold Off the Charts, this pullback shouldn't catch you off guard. Remember the risks we mapped out on the board in our previous videos? We called this one early. On January 8th, the market hit a wave of passive selling pressure. This isn't because the world is ending or because the big players have turned bearish, it's actually just simple math. Because gold and silver rallied so hard last year, they became overweighted in major portfolios. Now, passive funds that track the index have to act like robots, mechanically selling about $6 billion in gold and $5 billion in silver to balance their books. So everything happening right now is following our script perfectly. This dip is just a technical correction, or what we call a healthy change of hands. This bad news is actually a secret win. The chips being dumped by these passive funds are giving long-term investors who missed the first move a prime chance to finally get on board. In today's video, we aren't going to obsess over short-term noise. I want to zoom out and show you the macro big picture that is literally making history right now. We are at a historic crossroads where the entire landscape of global wealth is shifting. At the same time, we need to talk about how to handle the trades right in front of us. The U.S. jobs report non-farm payrolls coming out this Friday will be the ultimate test for the bulls. Today's content is high-level and packed with value, so make sure you stay until the very end. This could literally set the tone for your net worth in 2026. First, let's address the short-term risk everyone is buzzing about, the Bloomberg Commodity Index BCOM rebalancing. I've warned about this before, but I see a lot of you guys getting anxious because of the price swings. Let's break this down so you can finally stop stressing. BCOM is one of the massive boss indexes in the commodity world, with hundreds of billions of dollars following it. This index follows a very rigid mechanical rule. Every January, it resets its weights. Since gold jumped 66% and silver doubled in 2025. That's great for us, but for the BCOM index, it means gold and silver are too heavy. They've exceeded the allowed percentage for the index. So, between January 8 and January 14, these funds are forced to sell off their excess gold and silver futures to get back to their target levels. This is the exact reason prices have been under pressure lately. It's not a crash, it's just an algorithm executing an order. If it's up too much, sell some. On Wall Street, we call this a telegraphed move. Since everyone knew it was coming, the smart money was already prepared. In fact, a lot of the dip happened early because the market was front-running or pricing in this selling pressure ahead of time. Think about it. If you knew a giant sell order was coming next week, would you sell now to hedge or wait? This anticipation actually helped clear out the risk early. I want to be clear, this sell-off is a healthy reset for an overheated market. For long-term bulls, this is a buy-the-dip gift from the heavens. So my advice on these swings, don't overthink it and don't panic. Once these mechanical sell orders are finished, the market will head back where it belongs. Now that the short-term technical risk is out of the way, let's get to the main event. Listen close, because this is about your financial status for the next decade. While most people are staring at one-minute charts, a massive watershed moment just happened in the global markets. Here it is. For the first time in 30 years, the total value of gold held by world governments has officially passed the value of U.S. Treasuries held overseas. By the end of 2026, non-U.S. government gold reserves hit a staggering valuation of $3.93 trillion. During that same window, the total U.S. debt held by those same overseas institutions? Only $3.88 trillion. This is the first time since 1996, exactly 30 years, that central banks have more value in gold than they do in U.S. dollars. Do you realize how huge this is, team? This isn't just a random stat, it's the convergence of two 50-year trends finally meeting in 2026. Look at the two lines. The first is gold's massive rally, fueled by central banks buying tons of it to protect themselves from global chaos. In 2025, gold surged 66%, its best year since 1979. This inflated the value of the 900 million plus ounces held in government vaults. Why are they buying? Because they are losing faith in paper money and want real security. The second line is the decline of U.S. bonds. While gold is hot, the appetite for U.S. debt is freezing up. Why? Because the US deficit is out of control, and interest payments alone have topped $1 trillion. Think about that. A huge chunk of US tax revenue goes just to pay interest before they can spend a dime on anything else. This has creditors asking, can you actually pay us back? Is the dollar even going to be worth anything? Plus, the US uses the dollar as a weapon through sanctions, forcing countries to look for an exit. This flip, where gold beats bonds, is a massive signal. It's more about the symbol than the number. It's the first time that physical gold, an asset with no counterparty risk, has become more important on government balance sheets than US debt. I'm not saying everyone is quitting the dollar tomorrow, but this is a global vote for diversification. The world is telling the US, we can't keep all our eggs in your basket, especially when the basket is falling apart. And this is where it gets interesting for us. Goldman Sachs just dropped a report highlighting a huge contradiction that the mainstream media is ignoring. Here it is. While Wall Street tells you to buy gold, the actual gold positions held by U.S. institutions and regular investors are at historic lows. Data shows that gold ETFs make up only 0.17% of U.S. private financial portfolios. What does that mean in plain English? Out of $112 trillion in U.S. stocks and bonds, gold is basically a rounding error. Less than half of major U.S. funds managing over $100 million even own a single gold ETF. Those that do usually only have a tiny 0.1% to 0.5% slice. Even the pros only have an average allocation of 0.2%. This means there is a massive, dammed-up lake of money waiting to flow in. If U.S. investors simply move their allocation from 0.17% to just 1%, that would spark trillions of dollars in new buying power. This could be the rocket fuel for gold's next leg up. The deeper logic here is that the old efficiency and free trade era of the post-World War II world is over. We've entered the era of national security. Investors are no longer just looking for the highest return, they are looking for the safest power. In this new world order, gold is the ultimate hedge against failing rules and government debt dominance. Central banks are price-insensitive buyers. They don't care if it's expensive, they just need to own it. This creates a floor for the price that is much stronger than people realize. Now that we've covered the big picture, let's bring it back to the here and now. What is the next big catalyst for gold? It's all about this Friday's U.S. jobs report. Lately, the U.S. economic data has been pure drama. Take a look at the ADP report, the private sector jobs data from yesterday. The market expected 47,000 new jobs, but we only got 41,000. It's better than the scary negative numbers we saw recently, but it still missed the mark. Big companies are cutting back, and only small businesses are doing any end-of-year hiring. The takeaway? The U.S. job market is cooling down, but it hasn't completely collapsed yet. The economy is slowing, but it's not dead. Then we have the Fed officials speaking. Kashkari says the economy is resilient, so rates might stay high-ish. But even he admits we are near a neutral point. Barkin says we are in a delicate spot, and rate cuts would be like buying insurance. Then you have Waller, who is being very aggressive, saying we need big rate cuts over 100 basis points in 2026 because current policy is hurting the economy. Put it all together, and what do you get? A slowing economy, a weakening job market, and cautious companies. It's like putting an ice cube in a hot drink. It cools things down without freezing the whole glass. The market loves this. Not too hot, which causes inflation, not too cold, which causes a recession, but just right. This Goldilocks environment is perfect for gold. This leads us to the big non-farm payrolls report on Friday. Right now, investors are betting on about 61 basis points of rate cuts in 2026. If Friday's data comes in, weak fewer jobs, or a higher unemployment rate, the market will scream for more rate cuts. Keep this formula in mind. Weak data is equal to higher rate cut hopes, which equals lower dollar yields, and gold goes up. Since gold doesn't pay interest, when interest rates on bonds drop, gold becomes much more attractive to hold. However, I have to give you a heads up on the risks. Gold is still near all-time highs, so it's expensive right now. Because the news cycle has been a bit quiet lately, gold might react very dramatically to the Friday report. If the jobs data is surprisingly strong, gold might take a quick dip or a squat. If the data misses big, gold could take off to challenge its previous highs immediately. My overall take? I'm short-term cautious, long-term bullish. For us, the move is to buy the dip. Don't chase the green candles, but don't be scared when they turn red. Every pullback caused by an index rebalance is just the big money handing you a better entry price. Let's wrap this up. Even though the start of 2026 feels a bit bumpy, the path forward is getting clearer. First, the short-term selling is a paper tiger. The BCom rebalancing is just a technicality that doesn't change gold's actual value. This reset is healthy. Second, the macro game has changed. Central banks owning more gold than U.S. debt is a massive historical turning point. We are seeing a great migration from paper assets to real assets. Plus, U.S. funds are barely holding any gold yet, meaning a huge wall of money is still waiting to enter. Third, the data is on our side. A cooling job market paves the way for the Fed to cut rates, which supports gold prices. That's our deep dive for today. Remember, this analysis is based on my personal views and current market news. I'm here to help you organize your thoughts and get the market clarity you need, but this isn't a direct signal to trade. If this helped you feel a little less stressed about the market swings over the last 2 days, let me know in the comments. I want to hear your take. Don't forget to like, subscribe to Gold Off the Charts, and share this with your crew. I'll see you in the next one.